Have you thought about purchasing a home but not sure if this is really a good time or if you even qualify at this time? Maybe you don't know what buying a home entails. If you answer yes to any of these questions, then I am here to take you on a journey to home ownership. Now, I know you see a lot of things in social media. Your friends and family members have their opinions, and even the news are giving their opinions as well of what the market is like. But let's take a look at the current market in January of 2024. So, as of right now, housing prices are stabilizing. After the pandemic, housing prices increased dramatically. It was just almost unaffordable to even purchase a home. Now, even though we may never go back down to the prices of pre pandemic, housing prices are decreasing, they are stabilizing, and they are becoming more affordable than they were after the pandemic. Homes are staying on the market longer. And you may ask, well, why is that? Well, because of everything that is going on social media, the news outlets, and friends and family members giving their opinions, people just don't really know if it's a good time to buy or not. They're not trusting the housing market right now. And that's okay because one thing that I do know is that it's slowly becoming a buyer's market. So whenever we enter into a buyer's market, what is happening is there are more homes available than there are buyers who are purchasing properties. So builders and sellers now have more inventory on their books than they need. And because of this, they are offering incentives. Some of them are offering to pay anywhere from 10,000, 15. I've seen 25,000 towards closing costs, and also throwing in appliances and things like that in order to make buying a home appealing to the buyer during this time. So, whenever you see the market shift in that way, where builders are buying or offering incentives, and where they are offering to almost give you everything under the kitchen sink, then you know that we are currently in a buyer's market. They're even coming down on the prices of their homes because they're needing to sell these properties. So, again, that's why we see housing prices stabilizing. On top of that, interest rates are decreasing. So, 2.5 months ago, interest rates were in the mid sevens. Now you can actually qualify for a 6% interest rate. And there are certain circumstances where you can get an interest rate even lower than that. Now, lenders are becoming more creative. I'm not sure if you've heard of the 2-1 buy down or the 3-1 buy down, but what happens is, so say for instance, if you currently qualify for a 6.25 interest rate, if you qualify for the 2-1 buy down or the 3-1 buy down, your first year you will pay maybe 4.99% for the first year in your interest rate. And then the second year it may go up to 5.99%. And then the third year, to the duration of the end of your loan, you will pay that 6.25%. However, at any given time, if interest rates are go lower than the 6.25%, you can refinance into a lower interest rate. And lenders are expecting for this to happen. So this is the reason why they are offering these creative financing terms or creative interest rate terms that they are offering right now. Let's take a look at buying pre-existing versus new construction. What is needed? What are the similarities? What are the differences between the two? So when you're going into contract for a pre-existing home and a new construction home, both are pretty much the same. There are a few differences, but overall, you're still looking at providing the same documentation and still paying the same amount of money and covering the same cost. But let's look at some of those costs and things that we're looking at when buying pre-existing and new construction. So both will require an earnest money fee. And that's what you would call something like a down payment or a deposit. So you're saying, I am putting a deposit on this home. I'm paying my earnest money fee to take this home off of the market because I plan on purchasing this home within the next 30 to 45 days. Now, typically, the earnest money fee is anywhere around 1% or less. That can always be negotiated with the seller, especially on the pre existing side. On new construction, a lot of times they have a set earnest money fee across the board, and typically it cannot be negotiated. So that is the difference between the earnest money between the two. One thing that I do want to mention when it comes to earnest money, that's money that you don't lose. It actually goes towards your down payment and closing costs once you're ready to close on this property. You've been fully approved and you're ready to close. Option fee. So typically you will see the option fee paired with the pre-existing or included in the pre-existing contracts. Now the option fee is paired with the option period. And what that means is I look at it like the uh, get out of jail free card. So if I pay my option fee, and sometimes it's anywhere between 100, I've seen as low as $100 and as high as $300 on an average. Now that can be negotiated between the seller and the buyer, but an average between $100 and $300. The option fee is tied to the option period, and it's saying within 5 days. Usually, I see anywhere between 3 and 7 days for the option period. So it's saying within 5 days, I can change my mind at any time for any reason if I decide that I do not want to move forward with the purchase of this home. And if I change my mind within this option period and I've paid my option fee, then I can receive my full earnest money check back with no hassle. So that's something that I stress to my clients, that you really want to make sure that when you're writing your contract, you include an option fee. You pay the option fee as well, and you give yourself enough days to allow you to do your due diligence when it comes to the home. Now, speaking of due diligence, an inspection is something that you're going to need in order to make sure that everything is functioning properly and working as expected inside the home. Now, an inspection is an inspector is hired by you. It's a third party who has no interest in you nor the seller, but they're going to come in and do their work, their due diligence to make sure that, I always say there's 5 components that you want to make sure, especially when it comes to pre-existing, that you want to make sure it's functioning and working as it should. And those 5 components are the roof, the HVAC system, plumbing, electrical, and foundation. Now, all of those things are pretty much a quick fix. If the inspector comes back and says that the roof needs to be replaced, that's a quick fix. The HVAC system needs to be serviced. That's usually a quick fix. Plumbing and electrical, those things are usually quick fixes. So, okay, we can take care of those things. Now, when it comes to the foundation, I'm really iffy about that. I wouldn't encourage a new homeowner to purchase a property or with foundation issues or pre-existing foundation issues, because you don't want to move into a property and then 6 months to a year down the line, you're having to come out of your pocket with tens of thousands of dollars to repair the foundation. But anything else can be repaired pretty much easily. Now, in the event that the inspector comes back and says, okay, I found these issues, you get with the seller and you guys are not able to come up with a solution or are not able to agree on the repairs and things of that nature, then at that time, because you've had that inspection done during your option period, you have the right to back out of that contract and say, you know what, this is not the house for me. I'm going to continue my search. I want to cancel this contract, and you will receive your earnest money back to do so. Appraisals. So both pre-existing and new construction both will require an appraisal when you are purchasing a home through a lender. If you're not paying all cash for this home, then an appraisal is needed. And what that is, it's an opinion of value, the market value of the property. So the mortgage company, the lender, the bank, whomever you go through to finance your home, they will contact a third party appraiser. They have no relationship with the seller, nor the buyer, nor the lender. They're going to come out, do an evaluation of the property. They're going to look at the condition of the property, the area the property is located in, the size of the property, and they're going to compare that to homes within typically a 1 mile radius that have recently sold, that is comparable in size, condition, etc. And they're going to come up with an opinion of value. Now, at that time, if the appraiser says that the opinion of value is $285,000, but you've offered to pay $300,000 for this property, this is very important. The mortgage lender will not pay more or loan more for the property, lend more for the property than it is valued in the appraisal. So if he says 285 and you offer 300,000, at that time, either you as the buyer are going to have to come up with the additional $15,000 plus your other fees, your down payment and closing costs to cover the price of the home, or the seller is going to have to agree to bring the price of the home down to the 285. Now, that's something that usually can be worked out between the seller and the buyer, especially if depending on how far along in the process you are. Home warranty. I would encourage anyone who is purchasing a pre-existing home, even if you're purchasing a new construction home, to get a home warranty. These things are important because in the event that after you move into the property and your HVAC system needs servicing within a year, you have that home warranty in place where they should be able to come out, that home warranty company should be able to come out with little or no charge to you and service that HVAC system for you. So do your research, do your due diligence. Don't just Google home warranty companies and select the first home warranty company that's available. Make sure it's a reputable company. Look at the reviews. This is important when selecting these services or service providers to actually come out and assist you with your property. The inspection, same thing. You want to make sure that you do your due diligence on those. Try to find a reputable inspector with great reviews. Now, both of those, for the most part, everything is the same when it comes to pre-existing versus new construction. The biggest difference, and the one that has me more biased or more leaning towards new construction, is the builder's warranty that comes with the purchase of a new construction home. And that's because if anything goes wrong within that property, within usually they will have a 1 year, what we call bumper to bumper warranty, and then 2 or 3 years behind the wall, so electrical, and then 10-year structural warranty in place. If anything goes wrong, that's no fault of your own in that property within the first year, the builder will come out and fix or repair those items. So that's something to think about as well. That's something that I always try to encourage my clients to think about, the builder's warranty, because even though an inspector goes out to inspect the property, there are things that the inspector may not be able to see. There are things behind the walls that the inspector did not find. And so at that time, what do? There's nothing that you can do but come out of pocket to repair and replace those things. So that is something to definitely think about when deciding on whether or not you're wanting to purchase a pre-existing home versus a new construction home. Now, let's talk about credit. So, the question always comes up, well, what does my credit score have to be? Or can I qualify with a low credit score? So, with a 580 credit score, you can qualify for an FHA loan. You need at least a 620 in most cases. A 680 is even better when it comes to conventional, and I will explain that a little bit further later on in the video. 640 USDA loans, 620 for down payment assistance. So that's something that you want to think about. Those magic numbers, if you can get to those numbers, then more than likely you can qualify for a home. Trade lines. So you will need at least 3 trade lines under most circumstances. Now, there are some extenuating circumstances that we can work around if you don't have the 3 trade lines, but you do want to have those 3 trade lines. And trade lines are anything that reports to your credit report monthly. Now, you want them to be in good standing, you want them to be active. In order to be considered trade lines, they have to be active, and you want them to be in good standing as well. So this can include anything from credit cards, installment loans, car loans, finance company accounts, and things of that sort. So just keep those things in mind. And then credit tips. When it comes to credit tips, even though you're needing the minimum of a 580 or a 620, how do you maintain those credit scores? How do you improve on those credit scores? So this is what I'm going to talk about now. I know that a lot of times we use Credit Karma, Credit Wise, and even our bank apps to monitor our credit score. But if they're looking at your Vantage score, then that doesn't matter to the lender. The lender wants your FICO score. So I always encourage my clients to use myfico.com to monitor their credit reports. It's very educational, it's very easy to use, easy to navigate, and it provides a lot of information that could be helpful in your credit journey. You want to keep your credit balances between 10 and 18% of the credit limit. So, what does that mean? There's this thing called credit utilization. Your credit utilization is the difference between the credit limit and the credit balance. The higher your credit utilization is, the lower your credit scores are. The lower your credit utilization is, the higher your credit scores are. So if you have a 10 to 18% credit utilization on a consistent basis, I guarantee you more than likely you have a high credit score. Now, you want to keep a good mix of credit, installments, revolving accounts, all of those good things. And let me tell you, myfico.com is a great tool to use so that you can see if you have enough credit, if you have enough mixed credit, what is your percentage when it comes to those things. You do not want to get any new inquiries unless you're building credit. So if you already have your 3 trade lines that's reporting monthly to the credit bureau, you do not need to get any more credit. So when you go into the department store and they say, if you apply for this credit card, we will give you 30% off your entire purchase. You smile at them and tell them no. You already have your 3 trade lines. You're already working on building and maintaining positive credit. You do not need anything else that will come in to interrupt your credit scores. So the more new inquiries you receive, the lower your score will become. So you don't want to be labeled high risk by the credit bureaus because you're applying for everything that comes your way. You want to make sure that you pay all your bills on time, no 30-day lates. This is so important because one 30-day late can drop your score up to 85 points. 85 points can make, if you have a 620 credit score and you get one 30-day late, then you no longer qualify for a home at that time because of that 130-day late. Now, listen, I know that things happen and life happens to us all, but if you have to pay on the 29th day, then make your payment on the 29th day if you have to. And that means absolutely have to. You just did not have the money any other time during the month. But make sure you do not receive any 30-day lates, especially if you're on your journey to home ownership. Pay off those high credit card balances. Again, this is where we come back into that credit utilization. A lot of people do not realize, a lot of people think they need credit repair, and this stresses me out so bad because a lot of times we don't need credit repair. The only thing we need to do is pay our high credit card balances off. So that's where that credit utilization comes back into play. Now, I know a lot of times you will hear that 30%, you need to keep your credit utilization at 30% or below. I would encourage you to keep it at 10, between 10 and 18%, because life happens, things happen. That gives you a good cushion. And it also makes you look like a responsible person who, to the credit bureaus, who isn't dependent on their credit to live. And because of that, your credit scores will be higher than they would be if you were keeping it at 30% credit utilization. All judgments will need to be paid off. So if you have a judgment and you're applying for a mortgage, you will need to pay that judgment off. Student loans cannot be in defaults. And I know we do not like paying student loans. We do not like dealing with them. But if you're on your journey to home ownership, you will need to make sure that you are paying your student loans. Any disputes need to be removed from the credit report unless they are medical. Now, what do I mean by that? Whenever you go through credit repair or you're going through the process of repairing your own credit, you may have gone through and disputed every item, every negative item on your credit report. Some of those items were removed and some of those were not. For the items that were not removed, there's a note that's placed on that item by the credit bureau that says that consumer disputes discharge. If that note is placed on your credit report, the mortgage company cannot approve you for a loan with that note on the report. And I'm going to tell you why. It gives you a false credit score. So it's like a placeholder because they're not sure if this is correct, this if you truly owe this balance or not. So it's a placeholder. Now, in order to have that removed, the only thing you need to do is contact the credit bureau, provide them with the account number, and let them know that you want the dispute remark removed. Once that dispute remark is removed, what will happen is your credit scores will either decrease or they will remain the same. But it will now give the mortgage lender your correct scores, and if there is anything that they need to do or that you need to do to bring your scores back up, your lender should be able to provide you with that information at that time. Now, let's take a look at the different loan programs that are available. So, a lot of times we hear FHA loans. Everyone knows about an FHA loan. It's the most popular loan that is out there right now because it's the easiest to qualify for. It is backed by the government, and you don't need a whole lot to get approved when it comes to FHA loans. So, the minimum credit score requirement is a 580. It will get you approved, but not the best interest rate. So you want to keep that in mind. I always try to encourage my clients to at least get up to a 620 credit score. There's different perks when you get to the 620 mark than there are when you're at the 580 mark. And if you can get to a 580, you surely can get to a 620. So just keep that in mind. The down payment amount that you're looking at is 3.5% down. You will have to pay mortgage insurance if you put the minimum down of 3.5% for anything less than 20% down. Debt to income ratio. So with an FHA loan, typically the debt to income ratio is anywhere between 43% and 55%. And depending on the lender and their qualifications or their guidelines. Now, I want to stress that because FHA has their own set of guidelines, but each lender may have another stipulation on top of the FHA guidelines. So lender A may accept a credit score of 580 or above. But lender B may say, no, we want everyone we lend to have at least a 640 credit score. So that's something to think about. Always shop around. Do your due diligence. I cannot stress this enough. You want to shop around to see what each lender is offering, because there are so many different programs that are particular to certain lenders. Some participate in and some don't. So you want to be sure that you actually shop around when it comes to shopping for a mortgage, regardless of the loan type that you are approved for. Um, Employment. You will need 2 years of employment history and are able to explain any gaps in the employment history. Now, the 2 years, they don't have to be the same employer, but you want to have 2 years of consistent employment history in order to be approved. Now, let's talk about the conventional loans. Conventional loans, their loan guidelines are a little bit stricter than FHA. So you're looking at a 620 credit score, again, depending on the lender's minimum. A 680 credit score will allow you a better interest rate, lower down payment, and things of that sort. So with a 680 credit score, 680 and above, you can qualify for 3% down, which is lower than the 3.5% FHA loan. 620 will qualify for 5% down. And then again, anything over 20% down, there's no mortgage insurance. Now, when it comes to conventional loans, their debt to income ratio is a little bit more strict. So with them, they're wanting 36% in most cases, and then 50% with a higher credit score or with reserves. So that's something to keep in mind as well. USDA loans. This is one of my favorites. And really, because a lot of people really don't know about the USDA loans, but this loan type is for anyone who is purchasing a home in a USDA qualified neighborhood or area. Usually, it's a rural area that doesn't have any major grocery stores or a lot of population and things like that in the area. And so it's 100% financing. That means no down payment if you qualify and if the home that you're purchasing qualifies for the USDA loan. No down payment. You will need at least a 640 credit score. But you cannot have any more than one 30-day late in the last 12 months. Collections, judgments, and federal debt must be paid or on a payment plan. The debt to income ratio is usually around 50% maximum. And then there are income limits when it comes to the USDA loan. So if you have a household of 1 to 4 family members, then the annual income cannot exceed $103,500. 5 or more members, $136,600. Now that's what it is currently today. Those numbers can change. So always remember to do your research, do your due diligence. It's very important. This is a big one. Down payment assistance and grants. The thing that I want you to understand is that there are a lot of different down payment assistance programs and grants available out there when it comes to purchasing a home. There are some cities who have their own down payment assistance programs. There are some counties who offer down payment assistance programs. But these are the three that are widely used in the state of Texas. The T-Shack, it requires a minimum credit score of at least 620. It comes in a form of a grant, which you do not have to pay that back, or a forgivable second lien. Now, what happens with that forgivable second lien is, so say for instance, if you received $11,000 towards your down payment in down payment assistance, That $11,000, it becomes a second lien on your mortgage. Now, it's a second lien that you don't pay for, and it is forgivable over time. However, in the event, usually it's like a 3-year period that is forgivable. In the event that you decide to sell or you want to refinance within those 3 years, then that $11,000 will have to be paid off before you are able to do that. So that's something that I want you to keep in mind. I had a client who actually had a higher interest rate because they received down payment assistance and they had a second lien. Well, interest rates dropped during the pandemic to 2%. They weren't able to take advantage of that because they weren't able to pay off that second lien of $11,000 or however much it was. So they were stuck in their high interest rate because they couldn't afford to pay off that second lien. So that's something that I really want you to pay attention to when or take into consideration when it comes to down payment assistance programs and things of that sort. Now, with T-Shack, you are able to receive up to 5% in down payment assistance. You don't have to be a first-time home buyer. That is a myth, guys. It's a marketing technique. That's what I always tell people. They're like, I'm a first-time home buyer. Don't I qualify for it? That is a marketing technique. Just because you're a first-time home buyer, number one, it doesn't mean that you automatically qualify for down payment assistance. And number two, it doesn't mean that you won't qualify. Do your due diligence. If it makes sense, if the numbers make sense, if you just absolutely need down payment assistance to purchase a home and you qualify, then by all means, you get the services that are available out there. That's the resource that's available for you. But if you do not need it, then take that into consideration. Look at the bigger picture. Compare the different loans. Compare your loan with down payment assistance versus your loan without down payment assistance and see which one makes the most sense for your financial situation. The Seth Gold Star, again, minimum credit score 620, grant or forgivable second lien. Now, they will lend up to 7% in down payment assistance. Now, believe it or not, I have seen clients either walk away from the table with a check after they receive down payment assistance or even come to the table with zero money out of pocket. So just think about that. Keep those things in mind. Now you will have to take a home buyer's class, which that's an easy obstacle to overcome because you can do that from the comfort of your home at any time. Don't allow that to stop you. Again, there are income limits when it comes to the Seth Gold Star. Seth 5 star is a little bit more strict. You need a 640 credit score, grant or forgivable second lien up to 5% down, and must take home buyers class. There are income limits. Now, the thing that I want you to know is that there are mortgage companies that will offer down payment assistance programs, the T-Shack, Seth Gold Star, and Seth 5 star. There are mortgage companies that would not offer the down payment assistance programs. There are mortgage companies that offers their own down payment assistance programs. So those are some things that you definitely want to think about. You want to keep in mind. Do your research. You want to make sure that you're reaching out to multiple mortgage lenders in the beginning of your process. Ask those questions before you complete your application. The things that we're going over in this journey to home ownership video, write those things down. Make sure you ask the lenders those questions before you commit because you want to make sure that that lender is right for you in your situation. Self-employed borrowers. Okay, this is one that I definitely want to stress because a lot of times I know that if we make any type of money as a self-employed borrower, a lot of times on our W-2 forms, we take more deductions than probably needed. And in the long run, this can hurt you. So, if you are a self-employed borrower, the credit scores that are needed, if we are able to use your last 2 years of tax returns, that means that you can actually qualify for an FHA or a conventional loan, even as a self-employed borrower. Then all you need is a 580 or above. If we cannot use your tax returns because you have taken on too many deductions, at that time we would need to you would have to qualify for what we call a non-QM mortgage. And so we would need 12 to 24 months of bank statements, typically a 620 or above. Now, it could be higher than a 620 depending on the lender and their requirements. Down payment, you would, if we are able to use your 2 years of tax returns, you're looking at 3.5% down or 3% down, or maybe five, depending on whether or not you qualify for FHA conventional and what your credit score is. If we are not able to use your tax returns and we have to go the bank statement route, then you're looking at 10 to 25% down towards your down payment. If we have to go the bank statement route again, you're looking at a higher interest rate as well. Income calculations. The way that they calculate your income for self-employed borrowers, if we use your tax returns, we base it off of the AGI on your 1040 statement, on your 1040 tax return. So that's the adjusted gross income. So that's after we take your deductions, after your deductions are taken, what is your adjusted gross income? That's the number that we will use to qualify you for a mortgage. For the bank statement program, they're going to take the average of deposits. Now, this is not including transfers or income tax money or anything like that. These are the deposits that you receive on a monthly basis that are pertaining to your business. So I want you to keep those things in mind when you are qualifying or when you are wanting to go on your journey to home ownership and you are a self-employed borrower. Documentation needed. So I always want my clients to be prepared whenever they go in to apply for a mortgage. And so some of the things that you would definitely need upfront when applying, is you will need 60 days of bank statements, and you need to include all pages, even the page that says this page is blank. You want to include all pages of the bank statements and have them uploaded. They're going to look for NSF fees. How many do you have? Do you have any at all? Are they excessive, or was this a one-time thing? Was it just an oversight? Those are some of the things that they're looking for. Do you have money saved? Do you have money to um, use towards closing? Things of that sort. 30 days of pay stubs. There, you want to keep your pay stubs current. Some of the things that they are looking for on your pay stubs are you do you have overtime? Are you a full-time employee? Are you receiving 40 hours a week and being paid for that? Do you have any child support being taken out of your checks each month? Do you have any automobiles or insurance being taken out of your check each month, and not medical insurance, but sometimes people will have auto insurance taken out. So all of these things can play a part in your debt to income ratio. So just keep that in mind as well. 2 years of tax return, you will need those again to determine your AGI, what you may qualify for. They want to look at your last 2 years of tax W-2 forms to make sure that you have consistent work. You have 2 years of employment history. If you are receiving Social Security or retirement or anything of that sort, you can actually use that as income. If you have a 401k, if you have stocks, you can use that as income as well. All of those things can be included. You will also need to provide a copy of your driver's license and Social Security card for identification purposes. Now, these are the majority of the documents that are needed in the initial application process. If anything else is needed during the duration, during the loan process, then you will be advised of those documents. But typically, anything that they ask for, you can pretty much provide. And a lot of times, lenders will help you as well, guide you through what is needed and where to get those documents from. So don't ever think that you are in this by yourself, because we all want to get to the finish line when it comes to purchasing a home. So we discussed debt to income ratio when we were talking about the different loan types. So I want to break that down for you a little bit more. Your debt to income ratio is calculated by your gross income compared to the amount of debt that reports to your credit report monthly. So that's your student loans, your credit cards, your car payments, anything that's reporting monthly to the credit report. That's included in your debt to income ratio. And also your new mortgage payment. One thing that I always stress to my clients is, just because you are approved for a $500,000 home doesn't mean that you have to purchase a $500,000 home. Because when the lenders are looking and including your debt to income ratio, they're not including your daycare bill. They're not including your grocery bill. They're not including your gas, insurance. They're not including those things. The only thing they are including in your debt to income ratio is the amount of money, gross that income that you bring in each month, your gross income each month, and what is being reported to the credit bureau each month. So you know your lifestyle, you know what type of life you like to live. You know you like to buy new tennis shoes once a month. So if you purchase that $500,000 home, will you be able to continue to get your one pair of new tennis shoes each month? You have to think about those types of things. Or will it strain you? Will this be a burden on you? So just because you qualify for 500,000 based off of your debt to income ratio doesn't mean you have to purchase that amount of home. Income equals, this is an example. If your income is 5,000 a month, your monthly debt, what is reported to the credit bureau each month, is $600 a month, and your new mortgage amount is $1,800 a month. The debt to income limit is 50%. So we'll take that 5,000, multiply that by 0.50, that's $2,500 a month. So your new mortgage amount plus monthly debt cannot exceed $2,500 a month. Realtor.com has a mortgage calculator that you can use. That's a great tool if you want to play around with the numbers and things of that sort. Let's talk about student loans. Now, I stressed earlier that you cannot be in default and qualify for a mortgage if you're in default on your student loans. So if you are not paying on your student loans, 0.005% of the total loan balance will need to be included in your debt to income ratio. And you're looking at 0.005. Well, that's not a lot of money. But if you have, and I have seen this, $200,000 worth of student loans, that's a lot of money to include with your debt to income ratio, especially if you're not paying that much a month. And it can determine whether or not you will qualify or not for a home loan. Now, if you are paying on your student loans, then they only need to include the monthly payment amount that reports on your credit report each month. For example, if you have $50,000 in student loan balances, you're not making any payments, they're going to include $250 a month towards your debt to income ratio. Or if you have a $50,000 student loan balance and you're paying $50 a month, now I'm not saying you're just sending in $50 a month, but the credit report is actually reporting a payment amount of $50 a month. Then that's the amount that we will use towards your debt to income ratio. Now look at how this will make a difference. Again, the example, $5,000 monthly income, $600 monthly debt, $1,800 new mortgage, $250 student loan debt. Your new monthly debt is $2,650, which equals to 53% debt to income ratio. Now you are disqualified for a loan because you are not making the payments or have an income payment plan driven repayment plan set up on your student loans, or you don't have an affordable payment that you're paying each month that we can use as the calculation. So you want to make sure that you're making a payment, you're not in forbearance, especially if you have high student loan amounts and your debt to income ratio is very tight before the student loans are included. Keep those things in mind. We've spoken about credit needed. We've spoken about the different loan types. We've spoken about um, down payment assistance programs and all of those things. So, what are the costs associated with purchasing a home? Upfront, you will need your earnest fee and your option fee. If you are purchasing a pre-existing home, option fee, but you're definitely going to need your earnest fee. And remember, that number can be negotiated between the seller and the buyer as long as they come into an agreement. Inspections. I've seen inspections as low as $350 up to $550 on average. I've seen some higher as well. Again, do your due diligence, do your research, look at the reviews, ask your friends and family members, who did they use? How did they like the service? Find someone that's reputable that you feel like you can trust to get that inspection done for you. Just because the price is $350, that doesn't necessarily mean they're the best person to go with, and it doesn't mean that they're the worst person to go with either. So do your due diligence. Appraisals are typically anywhere between $550 and $650. I've seen some higher in some cases. There may be times when the appraiser, especially if you're buying new construction, the appraiser may have to go back out a second time. So an additional fee is attached to that. It's not as much, but it could vary. So just keep those things in mind. Those are the items that you would definitely need to pay upfront in the beginning of your contract stage. Once you go into contract, this is what you're looking at coming out of pocket with almost immediately: the earnest fee, option fee, inspection, and appraisal. Now, down payment, you're looking at anywhere between 3% and 20% down. That depends on you, depends on your credit score, and depends on what the lender is requiring from you at that time. Closing costs are typically anywhere between 3 and 5%. I know I have 3% on here, but on average, you're looking at between 3 to 5%. Those are going to include the lender's fees, attorney fees, title insurance, survey, credit reports, transfer fees, property taxes, which are usually are prorated depending on the time that you move in. That's when you will take over the property taxes or responsible for the property taxes. Homeowners insurance, you can shop around for the best rate, see what best fits your budget, what offers the best coverage, things of your sort. There's a lot of research that you're going to have to do when it comes to buying a home, just to make sure that you are getting the best deal possible all the way around. This is a huge investment, and one that you definitely want to take serious, one that you definitely want to be knowledgeable in the process and have someone to work with you that knows what they're doing, knows the answers, the questions to ask, and are able to provide you with answers as well. Now, we are at the end of the journey to home ownership. I hope that you guys were able to take away some valuable information. I will say that this, most of the information provided is really Texas based because I am a Texas real estate agent. So I just want to put that out there. But these are some of the things that I assist my clients with on a daily basis. If this information was valuable to you, if you can take it with you, please like and share and subscribe to my YouTube channel for more videos like this and more information like this. Again, if you have any questions, don't forget to put them in the comments. I will respond to them, as well as you can email me. I will drop my email in the email box as well, in the chat below as well. So you can email me or leave a comment, like and subscribe again. And I hope to talk to you all soon.